Russia's economy is dying a slow death, and the numbers are brutal. The economy today looks like a patient who jolted up from the operating table in 2024, only to discover the ICU lights still blindingly bright, the oxygen tank half empty, and the bill for the surgery already overdue. First, the headline numbers everyone heard about. Official statisticians blasted out a 4.1% gross domestic product jump last year, double what most forecasters dared to predict, and that eye-popping uptick traveled fast across social media feeds. Yet beneath the surface, the data flow is already rolling over. The latest first quarter snapshots for 2025 clock in at roughly 1 to 1.5% year-on-year, and every sober projection now crowds around a weak 1 to 2% range for the full year. Hang on, because the domestic demand engine that powered the rebound is about to run into a wall of shrinking energy cash, vanishing spare labor, and interest rates that would make a payday lender blush, and we will dive into each of those throttles in rapid succession. Start with the money Russia earns from the rest of the world. Oil and gas revenues. Everyone remembers the Kremlin boasting back in the high-price days of 2022, but May 2025 numbers show energy tax receipts down roughly 1/3 compared with the previous year. The world is awash in discounted Russian barrels rerouted to what Moscow calls friendly jurisdictions, but every discount slice is a lost ruble for the budget. Meanwhile, pipeline natural gas exports to Europe are on life support, hitting volumes last seen in the 1970s, and Gazprom is stuck producing more gas than it manages to sell, piling up unsold inventories that simply eat cash. The vaunted pivot to China through the Power of Siberia line covers only about 1/5 of the European shortfall, and expansion plans take years. The immediate consequence is simple: less foreign currency flows in, and the finance ministry has already chopped its 2025 oil and gas revenue forecast by a quarter. Anticipating the next question, if dollars and euros are evaporating, why hasn't the ruble collapsed? Because the Central Bank of Russia has kept the monetary screws turned so tight that the cost of borrowing rubles is now 20%, only recently trimmed from 21%. That sky-high rate forces exporters to swap their hard currency earnings into rubles immediately, and with limited options to move money abroad under capital controls, demand for ruble-denominated deposits remains artificially strong. Throw in mandatory foreign exchange sales and you get a firmer currency, about 77 to 80 per US dollar mid-year, 20% firmer than the panic lows 6 months earlier. Yet the price for that stability is brutal. Commercial lending has stalled, consumer loans are contracting, and households suck away whatever spare cash they have instead of spending because debt service is suffocating. Keep that in mind as we turn to inflation. Headline consumer prices, once barreling above 12%, have cooled only to the upper 9s. Core inflation is still double digits, and wage demands easily outrun productivity. The central bank insists it must push prices back toward its 4% target by 2026. That timeline itself tells you everything. Policymakers concede they need at least a year and a half more of monetary pain. Business owners already complain that raw material shortages, imported component gaps, and those same punitive borrowing costs make expansion impossible unless they supply the military. Which brings us to the war economy pivot that increasingly defines every statistic coming out of Moscow. Defense factories are humming, with transport equipment output reportedly jumping north of 40% in the latest year-over-year reading, metalworking up mid-double digits, and electronics lines cannibalizing anything that can be repurposed for drones, radios, or artillery guidance kits. Civilian automakers, furniture makers, plastics producers, you name it, are slashing shifts or closing doors entirely. Auto production alone is down nearly 14% this year, so the economy is not dying across the board, rather it is surviving in a distorted, militarized shape that props up headline industrial production while hollowing out consumer industries. In other words, GDP growth is powered by tanks and ammunition, not refrigerators and software exports. You might ask whether defense spending can sustain broader prosperity. The short answer, only temporarily, and only by draining fiscal reserves. The budget deficit, originally projected close to balance, already widened to roughly 1.7% of output by mid-year. 40% of public spending now bankrolls the military and security apparatus. To plug the gap, the government raids the National Wealth Fund, close to half a trillion rubles drawn in the first half alone, and sells more domestic bonds that banks happily purchase because the central bank lets them repost the paper for cheap liquidity. Even so, the rainy day chest has maybe 2.8 trillion rubles left and could be nearly empty by 2026 if current burn rates persist. The labor market looks like a paradox until you scratch the surface. Official unemployment sits near 2.3%, the lowest on record, yet the reason is more about scarcity than strength. A shrinking working-age population, war casualties and mobilization, and emigration of skilled professionals have left employers scrambling. Wage growth of roughly 10 to 15% year-on-year props up retail spending, for now, but it is also a key reason inflation refuses to die. Everywhere you look, companies say they may freeze hiring because financing costs and material shortages crimp future orders. Stay with me, because the worker shortage will bleed into productivity next. Productivity matters because without it, wage raises simply feed prices. Russia already lags peer economies in automation and high-precision manufacturing, and Western technology sanctions make upgrading equipment far harder. That is why you see import substitution translating not into sleek new domestic machines, but into reverse-engineered, lower-tech replacements that keep basic output alive but do little for long-term competitiveness. It is precisely here that the exodus of foreign direct investment bites worst. Inward investment shrank nearly 63% last year. Foreign portfolio positions roughly halved since before the invasion, and marquee multinationals have largely left. Even when Chinese or Gulf state investors sniff opportunities, Kremlin regulatory uncertainty, think asset seizures and opaque partnership rules, scares them off or capped their commitments. In effect, Russia must finance itself, and with the central bank choking credit growth to fight inflation, that internal pool is shallow. Let's pivot to geopolitics because no economic story today is sealed off from it. The Western sanction apparatus keeps tightening, closing loopholes, expanding import bans on dual-use components, and capping seaborne oil prices. If a new US administration after 2024 had chosen to slacken enforcement, Moscow might have caught a bigger break. But the current White House stance is firmer than anything seen during the Trump years when Washington often waffled on sanction rollouts and signaled mixed messages. European capitals, once split, are now largely synchronized. Even if another change in the Oval Office brings a softer verbal tone, the structural machinery of sanctions, Commerce Department controls, Treasury secondary sanctions threats, EU energy diversification, Japanese and Australian alignment, is embedded in law, making a whiplash reversal unlikely. Russian officials know this and openly discuss de-dollarization and closer Chinese financial links. But the UN is not a full substitute for greenbacks and global trade settlement. Next up is the current account tail. The current account surplus, once a colossal safety net, is narrowing fast as export revenues fade and import volumes gradually recover through gray channels. The central bank bragged about an $80 billion surplus in 2024. The consensus for 2025 has already been cut to the $40 to $50 billion window, or barely half. A slimmer cushion means any new oil shock or maritime insurance crackdown could swing the balance into deficit. Should that happen, pressure on the ruble would resurface, forcing the central bank either to sacrifice reserves or hike rates even further, neither of which builds growth. Savers are keenly aware, and capital flight desires simmer under the surface. The only thing preventing a torrent is the exit tax, the difficulty of moving money, and the frankly dangerous prospect of being labeled a foreign agent collaborator if caught funneling cash abroad. Let us talk resilience, because skeptics will note that Russia did not implode in 2022. Banks still clear payments, payrolls get met, and the ruble in people's digital wallets still buys groceries. True. But look at quality rather than existence. Inflation near 10% ravages lower-income households. Consumer loans shrink and interest costs eat into wages. Medical equipment shortages because of import bans show up in longer wait times and lower-quality treatments. Western computer chips replaced by mystery consignments from opaque intermediaries come with supply hiccups and higher defect rates. Infrastructure megaprojects touted on state TV rely on heavy imported components that arrive late and cost more. The cumulative drag does not show up in quarter-to-quarter GDP charts immediately, but grinds potential output lower over time. Investors who once saw Russia as a high-yield, stable fiscal rural petroeconomy have pivoted to Mexico, Indonesia, or India. The St. Petersburg Economic Forum in June 2025 highlighted the void. Western CEOs were almost absent, and even many Asian invitees sent mid-level managers rather than deal-signing chiefs. Domestic oligarchs can reshuffle assets among themselves, but bringing in fresh capital and technology from outside the sanctioned perimeter is a different game entirely, one that Russia currently loses. While we are on the subject of lost opportunities, consider human capital. Tens of thousands of IT workers left during the mobilization waves. Some return on short visits, but many have resettled permanently in Armenia, Georgia, or Germany. That brain drain throttles productivity growth in sectors that could have driven diversification away from hydrocarbons. Now zoom out to compare with peers. The International Monetary Fund pegs Russia's 2025 growth near 1.5%, slightly above the Euro area forecast of roughly 0.8, and just shy of US expectations around 1.8. One could spin that as relative strength, but context matters. The United States and the Eurozone do not run double-digit inflation or 20% policy rates, nor are their budgets dominated by war spending. They remain integrated into global technology, finance, and talent flows. Russia's higher headline growth masks deep opportunity costs and structural decay. Potential growth, the rate at which the economy could expand without triggering inflation, is falling toward 1% or worse, economists inside the central bank quietly admit. That is extraordinarily low for an emerging economy with vast physical resources. What about a ceasefire or peace deal? Even an immediate cessation of hostilities would not unlock rapid recovery, because sanctions tied to Crimea and election interference predate the current conflict and have bipartisan backing in the United States Congress. Business confidence also hinges on property rights credibility, and the list of recent expropriations, from Western energy fields to domestic airports, sets a chilling precedent. In other words, flipping the war switch off does not automatically reopen pipelines of foreign capital that took 3 decades to build and 2 years to unwind. Circling back to households, one looming storm cloud is consumer fatigue. Retail sales held up through 2024 on the back of wage hikes and pent-up demand. But surveys now show households turning more cautious, delaying big-ticket purchases, and elevating perceived inflation benchmarks above official projections. When people expect prices to rise double digits, they either rush to buy now, fueling another inflation wave, or they clamp down entirely, throttling consumption. The central bank fears the first scenario, the finance ministry fears the second. Neither sees an easy path to anchor expectations at the 4% target anytime soon. Let's not forget demographics. Russia's population has been shrinking for years, a trend accelerated by pandemic excess mortality, war casualties, and emigration. Fewer working-age adults mean smaller tax bases, higher pension burdens, and slower trend growth. The government raises the retirement age or taps migrant labor from Central Asia to patch shortages, but both measures run into political and social friction. A smaller, older workforce cannot support the same defense-heavy budget without deeper cuts to either social services or capital investment. Another fork in the road that looms closer each fiscal year. Technology is the next tripwire. Modern warfare and modern industry alike depend on semiconductors. Before sanctions, roughly 2/3 of chips used in Russian civilian and military sectors came from Western or allied suppliers. Sanction evasion networks now reroute components through Turkey, the United Arab Emirates, and Central Asian republics, but cost markups and delivery delays are endemic. Sub-6 nanometer nodes critical for advanced weapons and telecom remain out of reach. Domestic fabrication projects draw headlines, yet experts say Russia is at least half a decade behind and lacking in photolithography equipment, talent pools, and chemical supply chains. The consequence is widening technological autarky. Products become less advanced, more expensive, and globally uncompetitive. Because many ask whether China will step in as the ultimate lifeline, here is the blunt reality. Beijing values discounted Russian raw materials and shares an interest in challenging US dominance, but Chinese banks and state-owned giants still tread carefully to avoid secondary sanctions that could cut them off from Western markets. They cherry-pick opportunities that suit them, often extracting better terms because Moscow lacks alternatives. The relationship is asymmetrical, not a full-spectrum bailout. Fiscal reserve math reinforces the sense of urgency. At or below the $60 per barrel Western price cap delivers only thin margins after shipping and insurance costs. If Brent or Urals benchmarks slide further, the Kremlin faces the unpalatable choice of cutting social spending, slashing regional subsidies, or borrowing aggressively in domestic markets already saturated with government paper. Each route carries political risks. Austerity undermines popularity. Debt monetization collides with the central bank's inflation fight. Squeezing regions ignites tension between Moscow and local elites. Zoom back again to the big picture. At the start of the 2010s, many analysts touted Russia as one of the 4 BRIC pillars destined for multi-trillion-dollar clout. Today, the gap between that vision and reality is stark. Without large-scale technology inflows, stable property rights, and access to global capital, the economy has shifted from convergence to divergence. Even if headline growth sits at 1.5%, potential catch-up to advanced economy living standards is stalled, and some metrics, life expectancy, R&D intensity, export complexity, are reversing. Add climate dynamics. European decarbonization targets are steadily sucking demand away from fossil fuels. The United States Inflation Reduction Act, despite whatever partisan sniping you hear, is pumping unprecedented subsidies into clean energy supply chains. That accelerates the global pivot, leaving petrostates exposed. Russia has little time left to diversify, yet the war channels capital into defense, not renewables or next-generation manufacturing. Let's touch on the banking sector briefly. Capital adequacy looks solid on paper. But that is after regulators allowed banks to revalue fixed income portfolios generously and provide long forbearance on loans to sanctioned entities. Non-performing loans are understated. Profitability remains buoyed by high interest margins, but those margins compress if the policy rate eventually comes down, leaving lenders with securities acquired during peak rates that then reprice lower. The hidden stress builds. Finally, consider the psychological and reputational cost. Once an economy crosses the line into near-permanent sanctions land, multinational boards bake the risk premium into their strategic plans for decades. Executives who watched assets frozen or seized are in no rush to return even under a friendlier future administration in Washington. Trump's earlier oscillations on Russia policy taught boardrooms the risk of betting on a single election outcome, reinforcing caution. Where does that leave us? Not in total collapse, but in slow-motion contraction of potential. Reliant on high but declining hydrocarbon proceeds, forced to keep interest rates punishingly high and increasingly militarized. Every lever pulled to keep the machine humming. Tighter capital controls, bigger defense orders, deeper fiscal taps also grinds away at the very foundation of sustainable, broad-based growth. The line between a functioning war economy and a stagnating polity is thinning fast. As external revenues shrink and domestic bottlenecks tighten, the prospect of a self-reinforcing downward spiral grows. Barring a radical geopolitical shift or an unlikely moonshot domestic tech breakthrough, Russia's medium-term outlook can be summed up in one sentence: the patient is still breathing, but the prognosis worsens with every passing quarter.